My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make you some money. My job is not just to entertain, but to educate and put days like today into perspective. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Today we saw the dream session. The dream of what happens when the Fed stops tightening. Buy, buy, buy! That's how the Dow gained 549 points, while the S&P surged 1.97%, and the Nasdaq pole vaulted 2.05%. Unfortunately, it's just a dream, not reality. All right, what's the bullish dream? Okay, today the British Central Bank started buying bonds in order to hold down interest rates after just tightening less than expected last week. In other words, the Bank of England totally blinked. Immediately, our two-year Treasury, which has become the most important piece of paper in the entire world because it signified how tight our Fed had become, reversed and reversed hard, going from about 4.3% yield down to 4.1% in one of the most stunning moves I could ever recall. It was like the entire bear market transformed into a bull market because another country's central bank, not our central bank, another country's, gave up fighting inflation. So why isn't that good enough to justify today's rally? Because the Federal Reserve is not the Bank of England. In the next 2 days, we're going to hear, really likely, from a bunch of Fed officials who deny that they're going to blink, and it's just that they have the fortitude to fight inflation. They will be so downbeat and so determined that you will realize their dream is your nightmare. Sell. I have no doubt about that. Unfortunately, I do have some doubts about this Fed strategy, and it's time to talk about it. Because I've been pretty pro-Fed. See, I think the Fed has reverted to its previous non-data-dependent strategy back from 2018, where they actually didn't care what damage they did to the economy because they were so fearful of inflation. And they crushed everything when they adopted autopilot then. And you know what? They're going to do so again. Now, look, I'm not saying they're wrong to tighten. I think tightening's right. I'm not denying they were 6 months late to the party, although Jay Powell had nothing to do with the massive federal spending courtesy of the President and Congress. He didn't have much to do with price gouging by container ship operators, or the Great Resignation, or the loss of millions of Americans to COVID. Nor did Powell have any input into Vladimir Putin's decision to invade Ukraine, which raised the price of fertilizer 30 to 40%, something that hit you right in the breadbasket. And he most certainly didn't think that the People's Republic of China would repeatedly lock down its own people because their COVID vaccines barely work compared to the mRNA vaccines from Moderna or Pfizer. But those were Western-made, and President Xi does not like the West unless it's addicted to Chinese foreign policy giveaways. It doesn't matter. Powell had to play catch-up. The question now is whether he's already caught up or even past where he needs to be, at least for the moment, because if that latest triple rate hikes, and triple rate hikes, people, are very abnormal, and they can be staggering to the economy. Once you find out what it's like, it doesn't happen the next day. You don't say, like, whoa. It, takes a little time, even just a month to sink in. But they're not waiting. They're promising more hikes of all shapes and sizes to come. And I got to tell you, they know nothing. Yeah. They know nothing! The market's been tumbling ever since because Powell's abandoned his previous policy of data dependence. It's like he's decided in advance that all the inflation data would be too hot. Therefore, he has to hit us with repeated rate hikes just in case, that inflation is some sort of Hollywood villain that always comes back from the dead. Today, we saw what would have happened if Powell hadn't taken that lockstep approach. We would have seen the home builders soar. We would have seen a gigantic rally in the banks, which can make fortunes if the Fed stops putting more stress in the system. Most important, we would have had a gigantic leap in the tech stocks. Just stupendous. What's incredible is that before the Bank of England panicked, we were, for lack of a better term, about to crash. You heard me, crash. Just this very morning, at 5:05 a.m., the averages were plummeting, led by a rather anonymously sourced story about a pending Apple shortfall from weak cell phone sales, a story that I could not substantiate about the one big tech stock that was still holding up. Interesting, huh? I couldn't refute the story either because nobody in the Apple complex will talk to reporters. At 5 a.m., there was talk of a cascade, the final give up after 7 straight days, a moment where you feel like an idiot for buying stocks, especially since short interest rates once again seemed headed inexorably higher. Now, I've reminded you repeatedly that the Fed doesn't care about your portfolio other than trying to hurt it. I mean, really, put it generously. In reality, to the extent the Fed cares about your portfolio, they want it to go lower so that you have less purchasing power, which will then translate into less inflation. With Jay Powell on the warpath, it's tempting for people to dump their stocks and hide their money in the 2-year, collect that 4% and change risk-free. They want your stocks to lose money. It's okay. It's a game plan. I don't believe in it, but it's the plan. The Fed doesn't want your stocks down. That's not the only thing they want. It wants you to stop speculating, particularly in crypto. I am sure they wish that thing would just go away. And with your speculative money with it, okay? Just go away. The Fed wants your house to lose value, maybe 30% of its value, given recent price increases. They want mortgage rates so high, double where they were last year, that there will be no more bidding wars on houses, which have been a major source of home inflation. What a great way to stop home inflation than to make your home worth less. What a great way to stop stock inflation than to make your stock portfolio worth less. It all makes sense, doesn't it? Most importantly, the Fed wants you to fear losing your job. They want to make the prospect of retirement seem too expensive so that people rejoin the workforce and there will be less wage inflation. Now, I got to tell you, as someone in the restaurant business in New York, I know this is purely anecdotal, but give me a break. Things have changed dramatically from even a year ago. You want a job? Sorry, we do not need you. And that's the refrain I'm hearing. You walk down the street in Brooklyn and you get hit by resumes from people who work at restaurants. I fear Fed-inspired paper cuts. Totally different from a year ago when it was impossible to find help. In a way, Jay Powell did get lucky. Today, we got to see what would happen if he'd taken a less aggressive approach to bringing on the pain. He's already doubled mortgage rates in 1 year, and businesses have started to cancel big deals that would have brought tens of thousands of jobs, like the financing that fell apart for Tellurian, that risky liquefied natural gas play that just lost a chance to really build out some facilities we and the Europeans desperately need. Couldn't get the financing. I don't want to see Tellurian lose the opportunity to build a new LNG export terminal, but this is how you know that the Fed is winning. The Fed winning is bad for you. Short term. Longer term, I get it. Inflation is bad. However, if the Fed wants us to be poorer, to feel poorer, and to spend less so that prices come down, today's rally was a disaster. Sure, we were lucky enough to see what can bolster the market, none other than a lower yield on the 2-year. But if the Fed wants stocks to come down, well, now they know what to do. They can just send any minion out, any small, I don't know, from whatever region, and just say, look, rates are still too low. This was just a dip. Don't get your hopes up. And then today's gains will evaporate, and they'll be happy again. So I, too, am thrilled to see the market rallying hard. I am now terrified about which Fed head will come out, take one look like Groundhog, and say, holy cow, this is all bad. I don't know why these rates went down. It's not in the cards. And feel like it's imperative to point out that they're still planning to bring the pain on. This is the house they want you in.
The house of pain.
Not this one.
House of pleasure.
If you're one of the real Scrooges at the Fed, you say something like this. Did it occur to any of you 2-year Treasury buyers that it wasn't us started buying back bonds? It was over there. It was in Britain. We have our own agenda, and our agenda is to make you feel poorer so that you spend less money and the economy cools down, and we're not even going to wait a couple months for the next hike. We're just going to bring it on. Bottom line, the moment some Fed head explains the obvious, today's gains will indeed disappear because they're incompatible with the Fed's attempts to control inflation. This rally was based on a dream. And as we learned in the Maltese Falcon, the stuff that dreams are made of is not a valuable commodity. Let's go to Andy in California. Andy!
Good afternoon, Jim, and greetings from Chatsworth, California. The boss is here and wanted to say hello to you also.
Hi, Jim. You're awesome.
Anyway,
I'm
just an old retired guy living on a fire department and military pension, but
thanks
to your kind and intuitive and compassionate investing advice, been to very comfortably add to my income. So I want to thank you for that.
Thank you. We try so hard here. My whole team tries so hard, and it's been such a difficult market. So I'm really happy to hear that we've been helpful. How can I help now?
Oh yeah, I'm getting conflicting advice on a particular stock. In a previous Investing Club newsletter, Raymond James initiated a strong buy on a stock, and then another brokerage listed it as a strong bearish position. So I'm wondering if you could do a tiebreaker on Planet Fitness.
Well, we are huge believers in Chris Rondo. We think he's built a remarkable business. We think that they offer a service that this country needs, which is nationwide fitness at a reasonable price. And we are not against that. We are with it. The tie goes to the runner, which is Planet Fitness, and thank you for serving. All right, the moment some Fed head explains the obvious, today's gains are going to disappear because they're incompatible with the Fed chief's plan on controlling inflation with lockstep raises in rates. On Mad Money tonight, Lululemon announced today a new fitness platform connecting its users with a host of new offerings. And I'm learning more about the future of the fitness company and, of course, apparel company, with the company's chief brand officer. Then, even with today's bounce, the sentiment of the market is just plain awful. So what does this mean for your investing strategy? I'm going off the charts to find out. And Paychex CEO Marty Mucci announced his retirement set for the middle of next month. So I'm sitting down with the incoming and outgoing CEO to learn more about the transition and what lies ahead for this great company. So stay with Cramer.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.